Nature of accounting and a business. A business is an organization in which basic resources such as materials and labor are assembled and processed to provide goods or services to customers. The objective of most business is to earn profit. Profit is the difference between the amount is received from customers for goods or services and the amount paid for the inputs used to provide the goods or services. There are three types of business: service business, merchandising business, and manufacturing business. Let's see one by one. Service business provides service rather than products to customers. Merchandising business sell products they purchase from other business to customers. Manufacturing business change basic inputs into products that are sold to customers. So, accounting. What is accounting? Accounting has evolved in response to the social and economic needs of society. As a business and a society have become more complex over the years, accounting has developed new concepts and techniques. Now, define accounting. Accounting is the process of identifying, measuring, recording, classifying, summarizing, reporting or communicating, and interpreting economic and financial events of an entity for use by interested parties for the purpose of informed judgments and decisions. Now, let's look one by one. Identifying means tracing and collecting recordable economic activities. Accounting records and reports only those economic activities of an organization which can be expressed in terms of money. Analyzing and measuring determine whether the economic activities bring changes in an organization and expressing the changes in monetary terms. Recording systematically record of the effects of economic activities on assets, liabilities, capital, revenue, and expenses. Classifying grouping recorded effects of economic activity into meaningful class. Summarizing gathering and arranging data needed for preparation of reports and statements. Reporting preparing statements and reports in a manner that suits the need of users so as to communicate information useful for decision making. Interpreting provide explanation on reported information so that users can understand and use the information as a basis for decision making. Accounting is why accounting is important to determine the operation results of the organization, to facilitate its rational decision making for decision makers, to keep systematic record of business transaction. It plays important role in all economic social systems. What is characteristic of accounting? Understandability, expressed with clarity in which way that will be understandable to user. Relevance, this implies that to be useful, accounting information must assist a user to form, confirm, or maybe revise a view, usually in the context of making a decision. Consistency, this implies consistent treatment of similar item and application of accounting policies. Comparability, this implies the ability for users to be able to compare similar companies in the same industry group and to make comparisons of performance over time. Reliability, this implies that the accounting information that is presented is truthful, accurate, complete, nothing significant missed out, and capable of being verified. Example, potential investors. Objectivity. This implies that accounting information is prepared and reported in a neutral way. In other words, it is not biased towards a particular user's group or vested interest. Okay, now accounting as an information system. Accounting is used as a means to exchange information among interested parties concerning the financial performance, financial position, and the related issue of an organization. It is also commonly known as the language of business. An accounting system is designed to accumulate data about firms' financial affairs and summarize it in periodic reports called financial statements. Users of accounting information can be divided into two broad groups: internal user and external users. Look one by one. Internal users are those individuals directly involved in the process of either planning or controlling current operation or for formulating long-range plans and making major business decisions. Example of internal users, managers, and employees. External users are parties that are not directly involved in running the operation of the business. Examples include investors, creditors, government, suppliers, competitors. Assumptions and accounting principle. 1. Economic entity assumptions. Each economic entity exists separate from, independent of its owners and other economic entities under the same or different owners. 2. Going concern or continuity assumptions. The economic entity will continue in operating long enough to carry out its existing objectives and commitments. Third, accrual concept. This concept of requires that financial affairs of an economic entity should be recognized. For objective principle. According to this principle, an economic entity financial affairs to be recorded in its accounting record and reported on its financial statement must be supported by objectively determinable evidence known as source documents. Historical cost principle is principle states that goods and services purchased or sold should be recorded in the accounting records and then reported on the financial statements at the initial amount at the time of acquisition. Unit of measurement acception expressed in terms of monetary unit, national currency of the country. The distinction between bookkeeping and accounting. What is bookkeeping and accounting? Accounting is primarily concerned with the designation of the system of recording business transactions, the presentation of reports based on the recorded data, and the interpretation of the report. Accounting directs and reviews the work of bookkeepers. Bookkeeping is the art of recording financial transactions of a business enterprise to obtain and communicate necessary information for decision makers. Therefore, bookkeeping is the initial or the recording phase of accounting, business transaction, and the accounting equation. What is business transaction? It is an occurrence of an event or a condition that must be recorded. Transactions may be divided into internal and external. External transactions, those between the business enterprise and another entity. Example, purchase of goods from supplier, sales of goods to customers, borrowing money from a bank. Internal transactions, such as the expiration or transfer of costs within the enterprise. Example, depreciation of plant assets. Accounting equation is assets equal to liability plus owner's equity. Assets are resources owned or controlled by an economic entity and with the potential to provide future benefits to the business. Liability is obligation or debt of business that arise as a result of borrowing and or buying goods and services on credit. Capital is also called owner's equity. Net worth, net assets refer to resources contributed by or that belong to the owners of a business entity. Revenues refers to money or other assets received. Revenues refers to money or other assets received in exchange for goods and services sold to customers. There are money revenues, sales revenue, fees revenue, fares revenue, interest revenue, rent revenue, commission income, and etc. Expenses refers to goods and services consumed or used in operating or carrying on day-to-day activities of businesses. Example, cost of goods sold, supplies expense, salary or wage expense, utility expense, rent expense, commission expense, and extra. Financial statement. After the effect of individual transaction has been determined, essential information is communicated to users. The accounting statements that communicate this information are called financial statements. There are four financial statements. statement of financial performance, income statement, statement of change in owner's equity, statement of cash flow, statement of financial position or balance sheet. Parties of financial statements. Financial statements have two parts, heading part and body part, where heading part where name of business, name of report and the time period are written. Body part is where elements of financial statements are listed.